Okay, imagine this. You've got this huge global company, right? Factories maybe over here, design teams somewhere else, sales offices dotted all over the map.
Hmm.
Now, when that factory sends, say, parts to the assembly plant in another country, how do they even decide the price, that internal price?
Yeah, that's exactly where transfer pricing comes in. It's fundamentally about setting those prices for transactions within a single multinational group.
So not just finished goods.
Oh, no, it's everything. Physical goods, sure,
Yeah.
but also services, management fees, use of intellectual property like patents, even things like loans between related companies. It's kind of the financial plumbing that connects the whole group.
Right. So it's got to be more than just, counting neatness. There's strategy involved.
Absolutely. A big one is performance measurement. How do you know if your factory in, say, Vietnam is actually profitable if the price it gets for selling to the German sales office is artificially low?
Okay.
So
Makes sense.
it also influences decisions, like where you might want to expand production or R&D based on how costs and profits are allocated internally.
And then there's a big one, taxes. I hear a lot about companies using this to, well, shift profits around.
That's certainly the most debated area. The mechanism is interesting. If you charge a high internal price to a subsidiary sitting in a high-tax country,
Their profit looks lower there.
exactly,
Yeah.
and the entity receiving that payment, maybe in a lower tax jurisdiction, shows more profit.
Mm.
So overall, the group's global tax bill might potentially be lower.
But tax authorities must be watching this like hawks, right? That's this arm's length thing I keep hearing about.
Precisely. The arm's length principle is the cornerstone. Most tax rules globally basically say, look, that internal deal, it needs to be priced as if the two parties were totally independent, negotiating in the open market.
Like strangers doing business.
Essentially, yes, to prevent, artificially moving profits just to avoid tax. And this actually brings us to a really interesting current example, Nepal. They've just brought in some pretty comprehensive transfer pricing regulations, like 2024 recent.
Nepal. Wow. Okay. So that's a big shift for businesses there, I imagine. What kinds of challenges are they running into with these new rules?
Well, first off, it's the novelty. These are the first really detailed rules for them, so there's a steep learning curve for businesses just figuring out what's required.
Just getting their heads around it.
Exactly.
Mm.
And the arm's length principle itself, it sounds simple, but figuring out the right price, the right method to use for different transactions, goods versus services versus royalties, it gets complicated fast, especially if you don't have a big, dedicated finance team.
Right. And I'm guessing finding comparable data in Nepal, like what would two independent companies charge each other? That might be tricky.
That's a huge issue. Finding reliable comparables data on similar transactions between unrelated parties within Nepal's own economy can be really difficult. The data just might not exist or be accessible.
So how do you prove your price is arm's length then?
It makes benchmarking very challenging. Plus, these new rules demand detailed documentation. You have to justify why you chose a certain price, the method used, the analysis performed. That's a significant administrative burden.
And if you get it wrong or can't back it up.
Well, there are potential penalties, obviously, but also the tax authorities can just disregard your price and impose their own adjustment, increasing your taxable income.
Ouch.
And because the rules are so new, there's also just general uncertainty about how strictly or consistently the tax authorities will interpret and enforce everything.
Sounds like a bit of a minefield. Are there any like simplified options for smaller stuff?
That's another point. Currently, the Nepali rules don't seem to include what we call safe harbors. These are sort of simplified rules for certain low-risk or routine transactions that some countries have to ease the compliance load. Their absence makes it tougher.
Okay, let's make it real. You mentioned a shoe factory earlier. Say, factory in Nepal sells to its own sales office in, I don't know, Singapore.
Perfect example. So imagine the Nepal factory, let's call it Entity A, costs 500 rupees to make a pair of shoes.
Okay.
Now, if Entity A sells those shoes internally to the Singapore sales office, Entity B, for just, say, 510 rupees, the profit booked in Nepal is tiny, right? Only 10 rupees per pair.
Right.
But then Entity B in Singapore sells them to an external customer for maybe 1,000 rupees. The vast majority of the profit, 490 rupees, ends up being recorded in Singapore.
And if Singapore has lower taxes, I see. So that's the kind of setup the Nepali tax authorities would now scrutinize under the new rules.
Exactly that. They'd ask, is 510 rupees really an arm's length price? Would Entity A sell shoes to a completely unrelated distributor for such a small markup? If they decide no, an independent company would have charged more, it'd be 700 rupees.
Then they'd adjust the profit back to Nepal.
Precisely. They'd recalculate the tax owed in Nepal based on that higher deemed arm's length price. The goal is fair taxation based on where the value is genuinely created.
So it really is this complex balancing act, isn't it? Companies trying to run efficiently across borders, manage their costs, but also making sure they're compliant with these intricate and now very local tax rules like in Nepal. It leaves you thinking, doesn't it? What kind of specific skills or maybe advice do businesses, especially in a place like Nepal, really need now to navigate all this effectively?